Mr.Alpaca, Fundamentals in 5 minutes. Planet 13 is listed on both Canada and US stock market. Over the last 12 months, the stock traded between a range of $3 to $8 before it trended down to around $5 after Q2 earning. So, is Planet 13 a good investment? Planet 13 is a cannabis company that cultivates, produces, distributes, and markets cannabis and related products for medical and recreational purpose. It is headquartered in Las Vegas, but registered in Canada, as cannabis business is still illegal at federal level in the US. The company currently has 3 cultivation facilities with a total area of 41.6 thousand square feet, and they have the potential to expand to 2.4 million square feet to support its future growth. At present, there are 2 active production facilities with a total area of 14.5 thousand square feet. The third facility has a production space of 25,000 square feet and could be activated anytime to scale up the production. Las Vegas Superstore houses its largest facility that crafts its high-quality offers, flower, concentrates, edibles, vapes, tinctures, and topicals. They are labeled with Planet 13's premium brands such as Trendy, Haha, Medicine, Dreamland, Live and Vine, Planet M, etc. It is here that all magic starts. The cannabinoids such as THC, CBD, terpenes, etc. are extracted by distillation and mixed or infused into the products to create various effects and aromas. At this facility, customers could have a visual experience watching how the products are being produced. The company distributes its products via online store, wholesaling to 56 plus dispensaries and retailing in its own dispensaries. As of July 2021, Planet 13 has 3 retail facilities, 2 superstores and 1 medicine store with a total area of 35.3 thousand square feet. The company is planning to scale up to 83,000 square feet with ancillary stores. The superstores are Walmart-sized, large complex that offer an unparalleled customer experience focusing on unique interactive entertainment and some of the best cannabis products. The Las Vegas Superstore, together with its on-site production facility and restaurant, makes it the largest cannabis dispensary in the world, followed by the second largest that just opened in Orange County, California. Medicine facility is a smaller dispensary, which will expand to 4,750 square feet. These dispensaries not only sell Planet 13's house brands, but also offer shelf spaces for the other suppliers of cannabis-related products. Now let's talk about market expansion. Planet 13 plans to add 8 more superstores in coming 5 years. In August, the company won an adult use dispensing permit in Chicago, where they will have their 3rd superstore. The next one will be in Miami, Florida. Additionally, 6 more neighborhood dispensaries will be opened within 1 year. This ambition can't be achieved without strong execution of the management. Robert Groesbeck was a former mayor and practiced law for 25 plus years. Larry Scheffler was a former city councilor. Their connection and expertise are indispensable in this controversial industry. Each of them hold about 20% of the company, showing a strong confidence and dedication. The US has gone a long way towards the legalization of cannabis. 15 states, along with DC, have legalized cannabis for adult recreational use, and 36 states and DC permit medical use of the drug. If legalization at the federal level is eventually achieved, the company will have larger market opportunity, lower financing cost, and the possibility to be listed on New York Stock Exchange. Now let's talk about financials. Q2 earning was quite disappointing. While revenue has increased by 200%, net loss has widened by 33%. Share price tanked as investors start to question the profitability of the business. In fact, Q2 2020 is not a good reference as it was greatly impacted by pandemic lockdown. As long-term investors, we should consider the business on the normal operation. A better comparable would be Q1 2020 and 2021, as Q1 2020 was pre-pandemic and Q1 2021 was the last quarter. We are now looking at the statement of operation for the 3 quarters. I have listed the percentage of each expense on revenue. This statement helps us better understand how the company could achieve profitability. cost of goods stables around 45%. Unlike car manufacturers, cannabis cultivation and production can't benefit much from the economy of scale. General and administrative go steadily at 33%. A large part of this expense occurs as staff salaries, as Planet 13 focuses heavily on service and customer experience. This item can't see any meaningful improvement. As more retail spaces open, the company has to increase the budget to boost its brand. Therefore, sales and marketing expenses can hardly see any decline. Depreciation and amortization ranges around 3 to 6% and should be proportional to production capacity and revenue. Nothing much could be done here. The provision for tax is the excise tax that the business has to pay on its revenue, 50% for wholesales, 10% for retails. There is nothing can be done to improve. If we look at the net profit, it ranges between -10% to 5%. We have to ask ourselves this question: is this business even sustainable? Are we going anywhere with this company? The secret lies in the stock-based compensation, or SBC. It varies widely between 1% to 16% of revenue. What is SBC? In the case of Planet 13, it's options or warrants. It gives the right to purchase shares cheaper than the market price. In conventional IFRS or GAAP accounting practice, the SBC is recognized as expense, but in non-GAAP, it is adjusted as share dilution. To further explain this, let's say we have a company ABC, market price at $5 per share. It offers to its employee 100 options to purchase stocks at $4 per share. In conventional accounting, the company loses $1 per share multiplied by 100 shares in SBC expenses. This does not reflect the reality of the business, since the company actually receives $400 in cash while issues 100 new shares. Therefore, its financial position is strengthened at the cost of existing shareholders. It is a common practice for fast-growing companies to represent SBC adjusted margin as its operating margin. Let's look at Palantir Q2 earning. We can see the SBC is added back to its operating losses to better reflect its business. SBC adjusted margin makes sense only when the growth is much higher than dilution. If we look at Planet 13, the revenue for trailing 12 months was $100 million for Q2 2021 and $61 million for Q2 2020. That translates into growth rate of 64%. The outstanding shares was 196 million for Q2 2021 and 144 million for Q2 2022, marking a 36% dilution. Therefore, the dilution adjusted net growth is 28% for the last trailing 12 months. Now let's come back to the statement of operation. If we add the SBC back, we will see the adjusted operating margin for the last 2 quarters is already positive at 6%. In 5 years, I expect the cost of goods reduced to 40%, general and administrative to 30%, sales marketing to 4%, depreciation to 2%, and the adjusted operating margin to 19%. Cash position has grown steadily over the years, and the balance sheet is very healthy for Q2 2021. The cash is almost 14% of market cap, and the debt is ignorable. If we compare with other players in the cannabis industry, Planet 13 is the winner for almost all the benchmarks. Overall, the company has vertical integration, pioneer advantage, strong execution, and large market potential. As the cannabis bubble has already burst and the speculation money long gone, this company has a very good risk-reward ratio.